All right, welcome to another deep dive. This time we're taking a look at the simple path to wealth, and wow, did you give me a lot to get through.
Oh, I can imagine.
We've got excerpts from the book itself, we've got reader reviews, even some background on how the book came to be.
It seems like it really resonated with a lot of people.
It really did. So I guess my first question for you is, what are the main things someone should know about the simple path to wealth? If they're really looking to achieve financial freedom.
Well, I think for the author, J.L. Collins, he really hits on a mindset shift. It's interesting. He didn't come from a traditional path to wealth. He found financial success early on, and he uses this term FU money. And he used it in untraditional ways, like quitting jobs if he didn't agree with something, allowing his wife to stay home with the kids. So it's not so much about retiring early, it's more about having that freedom to make choices that align with your values.
So you're saying it's more about your finances supporting your values rather than just letting your job or your circumstances dictate your life.
Exactly. And to get to that FU money, he dives into some investing concepts, but always in a very approachable way. One of the biggest ones is compound growth. He illustrates it with examples from his own, 40 years of investing experience. He shows how even small, consistent investments over time can really grow exponentially.
It's like that snowball rolling down the hill,
Oh, all right.
picking up more and more.
Exactly.
Yeah, I think he uses some pretty eye-opening numbers in there, like what, $2,400 a year can turn into over a few decades.
Yeah, it really challenges how we think about saving.
For sure, for sure. But he doesn't just focus on earning. He's also really, really adamant about avoiding debt, calling it a vicious, pernicious destroyer of wealth-building potential. Pretty strong words.
Yeah, he doesn't mince words when it comes to debt. And there's that story about his daughter. She gets a credit card offer with an 18% interest rate. I mean, it really captures how, especially for someone starting out, debt can feel like a trap.
Yeah, it's a great reminder that building wealth isn't just about how much you earn. It's also about being smart with what you have. And speaking of being smart, he really, really champions index funds. In particular, Vanguard's Total Stock Market Index Fund, VTSAX. He believes it's like the cornerstone of a simple and effective portfolio. But I'm curious, I know some investors, particularly those who like to actively pick stocks, they might see that as too passive. So are there any arguments against that hyper-focus on an index fund like VTSAX?
For some people, it is about that lack of control. But Collins argues that picking individual stocks or trying to time the market is incredibly difficult, even for professionals. And he argues that with something like VTSAX, you essentially own a piece of every publicly traded company in the U.S. It's, what is it, like 3,700 businesses. So you have that instant diversification and that long-term growth potential.
So it's about capturing that overall market growth rather than trying to outsmart it.
Exactly, yeah. And it really does require, with this approach, a long-term mindset, which is
Mhm.
another core theme in the book. He talks about his experience in the 1987 crash, Black Monday. He just remained calm despite all the panic. He suggests that we treat market dips as buying opportunities, not a reason to sell. And that brings us to another one of his, I guess you could say, controversial points. He critiques dollar cost averaging.
Oh yeah, that really stood out to me. Most financial advice is like, spread out your investments over time, reduce your risk. But he really makes a case for lump sum investing when you can.
Yeah, statistically, he argues that being fully invested sooner often leads to better returns over time.
Yeah.
It is a bold stance. It challenges the conventional wisdom, but he backs it up with data. Of course, this assumes you do have a lump sum to invest and you're comfortable with that inherent volatility of the market.
Of course, yeah. It's not a one-size-fits-all approach, which I guess leads us to his different portfolio strategies. He talks about the wealth accumulation portfolio and the wealth preservation portfolio. What are like the main distinctions between those?
So the wealth accumulation portfolio is geared towards younger investors, those who are focused on growth. They have a longer time horizon. They can ride out those fluctuations. It's 100% VTSAX. And it's almost, he compares it to planting a tree. You don't expect fruit overnight. It needs time to grow into something strong. The wealth preservation portfolio, on the other hand, that introduces bonds for a little stability. So it's 75% VTSAX, 25% VBTLX, which is Vanguard's total bond market index fund. And that's for folks who are maybe closer to retirement or just looking for a little bit more stability in their portfolio.
So as you go through life and your financial needs change, Your investing strategy probably needs to shift a bit as well. But before we dive into those, I want to shift gears a bit and talk about another thing that Collins criticizes, the traditional financial advising industry.
Yeah, this is where his kind of frustration with complexity and fees really comes through. He is very critical of traditional financial advisors, claiming that their high fees, complex strategies, and potential conflicts of interest often work against the client's best interests.
Yeah, I mean, he really uses his own experience working at an investment research firm to illustrate how difficult, if not impossible, it is to beat the market consistently. So if he's so against advisors, what does he propose as an alternative?
He believes individuals can and should manage their own investments using a simple, low-cost approach centered around index funds.
So it's about empowering yourself through knowledge.
Exactly.
He's saying you can bypass those expensive advisors and take control of your own financial future if you just understand the basics.
He breaks it down in a way that makes it feel achievable, even for those who might feel intimidated by the world of finance. And he emphasizes that it's not about getting rich quick. It's about making those smart choices consistently over time. He even encourages readers to kind of embrace frugality, not as deprivation, but as a path to freedom and flexibility.
And that makes me think of another thing that he's a big proponent of, which is charitable giving. It almost seems counterintuitive when you're so focused on building wealth to prioritize giving, but he really makes a compelling case.
He does. He shares his own experience establishing a charitable foundation through Vanguard and highlights the benefits, both financial and personal.
It's really about aligning your wealth with your values, not just accumulating money, but using it to make an impact as well.
He stresses that it doesn't have to be complicated, Find ways to give back that are meaningful to you.
Yeah, that makes sense. So we've covered a lot of ground already. We've got that power of compound growth, avoiding debt, keeping it simple with index funds, the critique of traditional advisors, even the role of charitable giving. It's clear that the simple path to wealth is more than just a financial strategy. It's kind of a holistic approach to money and life. But I guess my question is, how do we take all this information and actually apply it? What are some steps that we can take to put these principles into practice in our own lives?
That's a great question, and that's one we'll explore further in the next part of our deep dive. We'll get into the specifics of his investing strategies, tax optimization tips, even his insights on the emotional aspects of investing.
All right, so we're back and we're diving even deeper into the simple path to wealth. In part one, we got a good overview of Collins' philosophy and approach, but now let's get into the practical side. Like, how can we actually apply this stuff?
Yeah, let's make it actionable.
Right. So Collins is big on simplicity, and he lays out these two main portfolio strategies. We talked about them briefly, the wealth accumulation and the wealth preservation portfolios. But how do you explain those to someone who's, like, just getting started? How do they choose?
Well, the wealth accumulation portfolio is all about, really maximizing growth potential. So this is for younger investors, those who have a longer time horizon. They can ride out the ups and downs of the market. This portfolio is 100% VTSAX, that Vanguard Total Stock Market Index Fund we talked about. And he uses this great analogy. It's like planting a tree. You don't expect fruit right away. It takes time to grow.
Right. So you put in the work, you're patient, you let that money grow over time.
Exactly.
Now, I know I said I was a younger investor, but I also get nervous when the market's volatile. What about people who are closer to retirement or just have a lower risk tolerance in general?
Absolutely. So for those folks, we've got the wealth preservation portfolio. It's a bit more conservative, and it introduces bonds into the mix.
Okay, for some stability.
Exactly. So it's 75% VTSAX and then 25% VBTLX, which is the Vanguard Total Bond Market Index Fund. It's like adding those shock absorbers to your portfolio, smoothing out the bumps.
I love that analogy. But I have to admit, even though Collins makes things sound simple, there are some topics he gets into that feel a bit more complex. Like when he dives into those tax-advantaged accounts, he talks about 401ks, IRAs, Roth IRAs, even HSAs. It can be kind of a lot, especially if you're not a tax expert.
Oh, absolutely. Taxes can definitely be confusing. But I think Collins does a really good job of explaining not just what those accounts are, but the why behind them. He helps you understand, like, the strategic implications of choosing one account over another.
So it's more than just, here's the tax benefit. It's like, how does this fit into your overall plan?
Yeah, exactly. Like, he talks about the Roth IRA. He's a big fan of the Roth, especially for younger investors or those who expect to be in a higher tax bracket later on.
Right. So it's kind of like, pay the taxes now, but potentially reap bigger rewards in the long run.
Right. And he even gets into some more nuanced strategies like converting traditional IRA funds to a Roth. It shows how a little tax knowledge can be really powerful.
For sure. But He also mentions a potential downside to those tax-advantaged accounts, the RMDs. Those required minimum distributions once you hit 70 and a half.
Ah, yes, the RMDs. Those can definitely be a pain.
It almost feels counterintuitive, right? You
Yeah,
save diligently for years and then you get hit with a big tax bill in retirement.
it does seem that way. But the good news is, Collins doesn't leave us hanging. He has some strategies for dealing with RMDs.
Okay, so there's hope. What are some of his suggestions?
Well, one option is strategically withdrawing funds before you hit that RMD age. Or you can convert a portion of your traditional IRA to a Roth, because RMDs don't apply to Roths.
It's like a chess match almost.
Yeah,
You're planning for the future and anticipating those potential tax implications.
exactly. You really have to think long term.
Now, something else Collins talks about that I found really interesting is using HSAs, health savings accounts, as an investment vehicle. Most people, I think, just associate them with medical expenses.
I know, right? It's kind of a hidden gem.
So what makes them so attractive for investing?
Well, for one, contributions are tax deductible, just like a traditional IRA.
So you're getting that tax break right away.
Exactly. And then the money grows tax-free within the account, just like a Roth. And if you need it for medical expenses, you can withdraw it tax-free. But if you don't use it, it just keeps growing and compounding. It can be a really powerful tool for long-term wealth building.
That's amazing. I feel like Collins is constantly looking for those like little loopholes in the system, those smart strategies that most people might overlook.
He really is. He's all about finding those advantages while keeping things as simple and straightforward as possible.
Absolutely. Okay, so as we head into the final part of our deep dive, I want to touch on one more thing that Collins emphasizes, and that's the psychological side of investing.
Yes. That's so important, and I think it's something that often gets neglected in conversations about money.
Yeah, it's not all about numbers and spreadsheets, right?
Yeah.
Our emotions play a huge role in how we manage our finances.
Definitely. And Collins is very open about his own struggles with fear and uncertainty when it comes to investing.
And we'll explore those psychological aspects even further when we come back for the final part of our deep dive. Okay, so we're back and ready to wrap up our deep dives into the simple path to wealth. We've covered a lot of ground, the power of compound growth, the simplicity of index funds, those sneaky tax advantages, and even those psychological traps that can trip us up along the way.
It's been quite a journey, but out of everything we've discussed, I think those psychological aspects really stand out. They're so crucial, yet often overlooked.
Totally agree. So in this final part, let's really zero in on that. Collins is pretty upfront about his own emotional experiences with investing. Like, he even talks about feeling fear and uncertainty during those market crashes, and he's a seasoned investor.
It's actually really refreshing to hear because it makes him so relatable.
Right. It shows that those emotions are totally normal. We're all human.
Exactly. And, he doesn't just acknowledge them. He provides some really helpful advice for managing those emotions and staying on track.
So let's dive into some of those psychological pitfalls. Which ones does Collins really highlight?
Well, I think fear is a big one. When the market takes a dip, it's natural to want to sell everything, to cut your losses and run.
It's that fight or flight instinct kicking in, right?
Exactly. But Collins argues that selling out of fear often leads to locking in those losses and missing out on potential rebounds. He reminds us that historically, the market has always trended upwards over time.
Okay, so it's about riding out the storm and trusting that things will eventually bounce back.
Yeah, exactly. But fear isn't the only culprit. There's also greed, which can be just as dangerous.
Oh, yeah. That temptation to chase those hot stocks, those get-rich-quick schemes. It's hard to resist.
I know, right? It's so alluring. But Collins cautions us to resist that temptation and stick to a well-thought-out plan. Slow and steady wins the race, right?
Absolutely. No shortcuts to real wealth.
Yeah.
Now, there's another psychological trap he mentions that I found really interesting: anchoring. What exactly is that?
Anchoring is when we get fixated on a specific price point and make decisions based on that anchor instead of looking at the actual value of the investment. So say you bought a stock at $100 a share and it drops to $50. You might be hesitant to sell even if the company isn't doing so well anymore.
Because you're stuck on that $100, even though it's not realistic anymore.
Exactly. And that can prevent us from making smart decisions.
It's like we're letting our emotions cloud our judgment. So how do we combat these biases? How do we make sure we're making rational decisions, not just emotional ones?
Well, Collins emphasizes the importance of having a clear investment plan, a roadmap that outlines your goals, your risk tolerance, your strategy.
That's like that North Star, right?
Yeah.
Guiding you through the ups and downs.
Exactly. And just as important as having a plan is sticking to it, even when those emotions start to take over.
Easier said than done sometimes. He also talks about finding that balance between staying informed and getting overwhelmed.
Yeah, it's easy to get sucked into that daily news cycle, all the market hype. But Collins reminds us that it's not about trying to predict every twist and turn. It's about understanding the fundamentals and tuning out the noise.
So be informed, but don't obsess. Good advice. Now, as we wrap up this deep dive, I want to bring it back to one of Collins' most powerful ideas, that concept of FU money. Such a striking term.
It is, but it's so much more than just a number in your bank account. It's really about freedom, isn't it?
Right, that financial freedom to make choices that align with your values, not your constraints.
Exactly. Like being able to walk away from a job you hate or a relationship that's not working or anything that's draining your energy. That's powerful.
It is. But as we've discussed, it's not about winning the lottery or finding some magic formula. It takes work, dedication, making smart choices consistently.
Exactly. It's a journey, not a destination. It's about embracing that long-term perspective and staying the course, even when things get tough.
And I think it's also about recognizing that true wealth isn't just about how much money you have. It's about how that money empowers you to live a life you love.
Could agree more. It's about aligning your finances with your values and creating a life that feels truly fulfilling.
So as we close out this deep dive, I want to leave our listeners with a question. What step, even a small one, will you take today to move closer to your own version of FU money? It might be adjusting your budget, increasing your savings rate, or maybe even just reading that book we've been talking about. Whatever it is, take that first step and keep moving forward. And until next time, happy investing.